Hi everyone, this is Athar Mansoor from Tracks. In this video, I am going to review for you the Economic Survey of Pakistan 2024-2025. Let me share the screen with you. All right. So the Economic Survey of Pakistan is a very important document which is released by the Ministry of Finance or published by the Ministry of Finance every year. And it usually covers the period from July of the calendar year up till April of the next calendar year. So it is the fiscal year of Pakistan, as you know, it straddles across 2 calendar years. It starts on 1st of July every year and ends on 30th of June next year. So the data covered in this economic survey is from July 2024 up till April 2025. Whereas, yes, in some domains, the data goes beyond that. For example, foreign exchange reserves have been shown till 27th of May, 2025. Anyways, so this document was released on 9th of June 2025. And overall, it shows or tries to portray a positive outlook of the economy of Pakistan for the outgoing fiscal year, and it has emphasized the achievements in terms of stabilization and reform. However, a critical look over this document or a critical analysis of this document reveals important nuances and the persistent challenges which can temper the overall optimistic outlook. The government has stated some key areas as success and as on positive trajectory. And the first one is macroeconomic stabilization and growth. And government categorically states in this document that it has achieved for Pakistan's economy macroeconomic stabilization and upward trajectory. Real GDP growth has been shown as 2.68% with a medium-term projection of 5.7%. Per capita income has also been shown to increase by 9.7% to 1824 US dollars. The second area which the government has highlighted in terms of achievements, in terms of its economic achievements, is the dramatic inflation control, which fell to 6-decade low of 0.3% in April 2025, in comparison or in contrast to 17.3% to the year prior to this fiscal year. The headline inflation, which is also called CPI, for July-April was 4.7%, which was substantially lower than 26%, which was recorded for the previous fiscal year, 2023-2024, in the same period. The government has stated that it has been able to control or dramatically control the inflation because of monetary tightening, fiscal consolidation, stable food supplies, favorable global commodity prices, and base effects. The policy rate by the State Bank was also reduced to 11%. The third area where the government has shown its achievements is the fiscal area or the fiscal performance. The primary surplus of 3% of GDP for July-March, up from 1.5% in the previous year, has been shown as a big achievement. Another area where the government, in terms of fiscal performance, has shown its performance is fiscal surplus of 1.896 trillion, which is 1.7% of GDP for the quarter July to September, which they say that this has been achieved first time in 24 years. However, the fiscal deficit significantly has decreased to 2.6% from July to March, which is a longer time horizon in comparison to July or September, which has been shown in the previous bullet. The total revenues surged by 36.7%. Now, moving on to external account, the government has stated that it has achieved unprecedented current account surplus, which was 1.9 billion US dollars during the period from July to April. And they say that it is actually a reversal of what happened in the previous fiscal years. The government has claimed that it was bolstered by record growth in foreign remittances, which were 31.2 billion from July to April US dollars. Foreign exchange reserves have also increased to 16.64 billion as of May 27, 2025. Another achievement which the government has shown is the enhanced investor confidence and capital markets. The government has categorically stated that Finch ratings have been revised, and Pakistan's sovereign credit ratings from CCC or triple C plus have moved to B minus with a stable outlook. The Pakistan Stock Exchange delivered an impressive 50% return, with the Karachi Stock Exchange 100 KSE 100 index growing by 50.2% during July to March. Moving on, the government has also highlighted international endorsement of its economy. For example, IMF, under the first review of EFF, has acknowledged Pakistan's improvements in economic and fiscal indicators and approved 1.4 billion US dollars under the Resilience and Sustainability Facility for Climate Resilience. Debt management has also been shown as an area where Pakistan's economy has improved, because Pakistan's debt profile has strengthened with an extension in the ATM, which is the average time to maturity of domestic debt, from 2.9 to 3.5 years, which aims to reduce refinancing risks for the country. So these were the things which were highlighted by the government, but we need to critically see these developments, and we need to understand the nuances and the underlying challenges. Although the framing done by the government is strong, positive, but if we take deeper dive or delve deeper into the sectoral performance and financial detail, we think we will come across some facts or some information which can in fact indicate underlying structural issues which require continuous attention by the policymakers and government. For example, the first thing which can be revealed through a deeper critical analysis is the modest actual GDP growth versus ambitious projections. As I have shown in one of my previous slides, the medium-term GDP growth is projected to be 5.7%, whereas the actual real GDP growth was 2.68%. So there is a big gap. There is a big gap in this. Where the projection is almost double of the real GDP growth. And this means that significant reforms would be required. And unless those reforms are implemented or executed, this higher growth trajectory seems a far-fetched reality. So we can say this can be more of a goal than a current reality. Moving on, Pakistan's backbone agriculture just grew by 0.56%. And the major share in this growth was livestock, which contributed 4.72% in the growth. Important crops have actually declined by 13.49%. So it's a big blow. Contractions were seen or witnessed in cotton, wheat, sugarcane, maize, and rice. So this indicates vulnerability in Pakistan's agriculture base, which is fundamental to its food security. Also, we see that the industrial sector and the large-scale manufacturing witnessed contraction. The industrial sector showed overall growth of 4.77%, but the large-scale manufacturing contracted by 1.5%. There are persistent structural bottlenecks which have elevated the cost of the input and have impacted negatively these key sectors. Core manufacturing is still struggling with fundamental issues, and even mining and quarrying sector also contracted by 3.4%. Now, coming to the trade deficit, which is highly important for observers of Pakistan's economy. Pakistan's trade balance in goods, in fact, widened by 3.3 billion US dollars in contrast to the fiscal year 2023-2024. Imports grew by 11.8%, whereas the export growth was only 6.8%. There still exist structural challenges in Pakistan's trade and competitiveness, where import demands continue to outstrip export capacity. And this has had a negative impact on Pakistan's external account because it is heavily reliant on remittances and not on trade or exports. We also saw that the financial account outflow and declining FDI has been a question mark in Pakistan's recent economic history. The financial account recorded a net outflow of 1.6 billion, reversing a net inflow from the previous year due to higher government debt repayment. So government debt repayment increased, and so this reversed the net inflow. Net FDI slightly decreased to 1,785 million or 1.785 billion US dollars in comparison to 1.835 billion for the fiscal year 23-24. So investment-friendly reforms mentioned in the document have not yet translated into significant surge in FDI. Moreover, there is high public debt and cost of borrowing. The average time to maturity of domestic debt has extended the total public debt, which remains substantial at 76,000 billions. So it is about 76 trillion rupees. Fiscal deficit financing was fully met through domestic markets, which means that there is the risk of crowding out for private sector credit. And despite a reduction in the policy rate, the weighted average lending rate remained at 15%, which is high. And this indicates that the cost of credit is not small for businesses. Pakistan's biggest challenge, I think, remains in terms of human capital deficiencies. Literacy rate is 60.65%. And there are huge disparities between urban and rural areas and between males and females, as you can see in the data flashed on your screen. 38% of children are out of school nationally, and things are pretty bad, rather very bad in Sindh and Balochistan. Balochistan is really struggling. Only 69% are, only 31% go to school and 69% are out of school. These long-standing issues in education and human development indicate that economic gains need to be consistently directed towards inclusive growth and social upliftment to have a broad-based impact. Finally, in conclusion, I would say that although a positive picture has been portrayed in this document, we need to critically read this document. And if we do a critical reading, deeper reading, this document reveals that significant structural reforms are still needed for boosting core productive sectors, just as I have mentioned, which are important: agriculture and large-scale manufacturing. And we need to address the widening goods trade deficit. It is extremely important that Pakistan should become export competitive country, and we need to invest in human capital as shown in the last slide. Unless we do this, the long-run economic benefits cannot accrue, and Pakistan cannot move towards equitable and sustainable growth. Viewers, thank you so much. Please subscribe to our channel Tracks.Pakistan. We have a wide playlist, a huge playlist covering wide range of topics that could be of use to you. Stay tuned for more. Join Tracks.